your morning. And thanks for Taryn for recording. We will put this up on YouTube for anyone who has missed it. And I think without further ado, I'd just like to introduce my colleague, for those of you who don't know her, Emma Swart of Investec and Nedbank Private Wealth fame, who's been with us a long time and is the director of OrbVest SA, and certainly very instrumental in managing our investment committee and coordinating them. And so has a lot of insight, some of the data that we're going to highlight tonight. I think the purpose of tonight's webinar, guys, is really every year you do have a series of seminars that happens roughly at this time of year. Particularly Revista is of interest to us. We do monitor what's going on in the healthcare space. Obviously, it's very, very crucial to us to understand and to have a good understanding of what the trends are and what movements there are. And so this is just really a little bit of a follow-up for you so that you can get an understanding of what's happening in our space. We have some slides, obviously, for you tonight, and if we'll just stand by while I get the presenter view handy. Emma, are you seeing the...
No, not yet.
Your pardon? Let's try that again.
Yeah, all good.
How's that?
Perfect, working.
All right, excellent. So just before we start, our traditional disclaimer: please don't take any of this advice we give you tonight as any advice of any kind. Just to bear in mind that these are our opinions, and the data we'll be providing comes from third-party sources. We do our best to validate them, and you'll see that on the bottom of each slide there is the source of the data that we're using. And of course, just for those of you in the US, we file under 506C. In South Africa, we are an authorized financial services provider. And please just take a moment to familiarize yourself with that disclaimer. So I think from those of you that are in the US, you'll understand what's going on in the US, but for the rest of you that are not really familiar, I mean, I returned a couple of weeks ago from the US, and I think that, you know, the short story is that it certainly doesn't feel like a country on the brink of recession. I think that you know, you queue for a restaurant on a Monday night. There is you know, job opportunities at every second storefront. It certainly doesn't feel like, as I mentioned, a country that is about to be or potentially in a recession. So this is just a very interesting slide, and it's some of the data that we do watch on a regular basis. The line to have a look at here in blue is the SOFR rate, which is the standard overnight financing rate, and this is becoming highly important and has certainly replaced some of the other measures of interest rates over the last year or two. But I think that the important thing is we are in a very high interest rate cycle. And why I put the slide up is just to illustrate that the 5-year and the long-term money, in other words, if you look at the red line, that's effectively the rate that we look at, and it is highly critical. So you can see that on treasuries, there is a price point of 3.8% for treasuries that are trading 5-year treasuries, and 10-year treasuries even lower. So I think it's just important to see that the market anticipates that rates will come down getting into 2024, 2025. So that is just an interesting point for our non-US attendees tonight. The other thing that I find very interesting is the US seasonal adjusted employment rate. And this takes us from 2021 through to 2023. And certainly if you're looking at an economy with a 3.4% unemployment rate, those that really are unemployable are probably unemployed. And you can see there's a little bit of an uptick, and this is obviously what the Fed has been trying to achieve to slow the economy to get inflation down. Inflation, as you are probably watching, is dropping. They anticipate getting to just above 2 by the end of 2024, 2025, and below 2 and back to the 2% threshold going forward from 2025 onwards. So there will be some slowing of the economy. There will be perhaps an uptick in jobless rates, but right now it's not significant. And certainly, if you look at our situation in Southern Africa or South Africa, with our unemployment rates, I think you get a context of what I'm saying. Quite similarly, I think anybody considering investing in the US needs to understand that this is a really huge economy and it continues to power ahead. And again, certainly a lot of the press and what we read on this side is that, it is an economy that is under enormous pressure. But the fact is that it isn't. It is still growing at a consistent rate, and we still believe that it is fundamentally the strongest economy to invest in at this point. So I guess this gets us to the point of the conversation that we all really are interested in. And what I want to go through is a couple of the drivers that we consistently talk about that make us excited about this medical office space. And I think that if you look at hospitals, 1.8 billion square foot, you'll see from the slide, of space versus 1.6 billion odd square foot of medical office building space that is currently rented or tenanted. So there's significantly more value in the hospital space. Why am I showing you this, I guess? And that is really the first driver. So what is happening is hospital patient revenue is moving from, if you look at 1995 on the graph on this left-hand side, let me get you a little pointer, if I can find it. And you'll see that 70% of patient revenue or patient wallet being spent on healthcare was going into the hospital system, versus 30% into your traditional medical office, perhaps your dentist, your general practitioner. You can see what has happened over time is that the inpatient revenue, just to be clear, inpatient is someone who sleeps in the hospital overnight, and outpatient, you don't sleep in the hospital, you sleep out of the hospital. So effectively, that is a decreasing share of wallet versus an increasing share of wallet for the outpatient revenue. And in 2019, those curves actually merged. Now you can see they have separated a little bit, but the value, and this is the point of this driver, is moving away from the hospital system into the medical office block system. And this is very clear if you look at all the data, some of which we'll present tonight. This is probably the topic for a whole new webinar, but why are these, what's happening and what's pushing revenue out of the hospital system? And in a kind of elevator pitch, I'm going to just tell you that there's a couple of major things. One of them is cost, because no insurance company wants a patient to be staying over in a hospital when they can go for a procedure and come out the other day. So they're pushing patients into the day hospitals or outpatient environment. Secondly, it's technology, and technology also means changes in health sciences. For example, anesthetics are super efficient now. You can go in and have laparoscopic surgery and a general anesthetic and walk out the same day. And that is something that would have been unheard of 10 years ago. So there has been a significant change in technology, which is pushing people or reducing the need to have to be kept overnight for observation in a hospital. So driver number one, shift to outpatient locations.
Yeah, and that, that one, Justin, we looked at that quite a lot, the data with regards to, you see where those lines crossed over with regards to how much of the driver was due to hospitals closing through COVID, elective surgeries being stopped. And funnily enough, when we looked at the data, once the elective surgeries had opened again and the hospitals were at full operating, capacity and ability, there was still over 40% of private medical care claims going through the outpatient centers. So this showed after COVID, regardless of the option of going to a hospital for a certain surgery or off-campus, outpatient, there were still more claims, more than 40%, that we're continuing to shift towards the outpatient centers.
Thanks, Emma. Yeah, that is absolutely true. Let's move into drivers, aging population. So the US, guys, is an aging population. And you can certainly see that 73 million Americans will be over 65 by 2030. At that point, 1 in 5 will be older than 65. Quite an incredible stat. Growth is particularly pronounced in states including Florida, Montana, New Mexico, Texas, where 25% or more of the population in 2030 will be 65 years or older. Why I'm mentioning those states is you'll notice that those are states that we just happen to target and be active in. But I guess, why is this so relevant to us, and why do I call this a driver? And that's really this data here. So if you look at annual physician visits, the population in red below at 65 years and older spend roughly $19,000 a year on healthcare, whereas the population below 45 spend less than $4,300 a year. So you can see that there is a nice convergence of older people requiring more healthcare, an aging population, pushing more people into that category where they need to spend more on healthcare. And then back to driver number 1, a movement out of the hospital system into the medical office. And then there is another very useful tool, and that is that we can ascertain where the aging population is moving to. And so we do look at states that have very strong growth, and particularly if you note Florida at 1.9% growth annually, and the other red states, Texas, there's the Carolinas, there's Georgia. So I think you can see that not only do we pick states where there is natural growth in population, but where there are an older population that is moving away from the higher taxed states, colder states, towards a warmer climate with lower taxes to retire. So again, another driver that's pushing people to specific areas where, once again, demand will increase because of that driver. Finally, it's healthcare expenditure, and this is quite fascinating because there have been various presidents over time that have come in that have tried to make an impact on this growing healthcare expenditure. And to take the red line, you can see that in 1980, it was roughly 2% of GDP. All the various actions taken by various governments effectively have not impacted or brought that expenditure down. And you can see that it is now up around about 4%, if you ignore that little COVID bump over there. And it is projected to continue to grow. And if you look on the left-hand side, the percentage of GDP, percentage of GDP, and you can see that it is, continues to grow substantially over time. So I think that we need to understand that the office environment in the US is under significant pressure, like it is in most parts of the world. One of the impacts of COVID that is going to stay with us forever is that people are working from home. They've learned to work from home. Companies have got to understand that their employees can work from home. And this is putting significant pressure on the office market. So I guess one of the questions is medical healthcare facilities impacted by this large vacancy in the office sector? And the answer to that is clear from this slide here. Throughout time, you can see that the occupancy of medical office centers haven't been impacted considerably. 2022 into 2023, over 90% occupancy consistently. And I think it's very important to understand that, yes, while there is some leakage of your tenants, medical tenants that aren't specifically required to be near other doctors in a synergistic relationship, for example, your physiotherapist or your psychologist, that certainly doesn't need to be in a medical center. They will leak off to office buildings that might be cheaper. But it is what we have learned is that medical tenants like to be in a synergistic environment where they can refer patients to the laboratory at the bottom of the building, send them for imaging, or for that matter, in our dentist buildings, which are quite fascinating, refer them to other dentists that specialize in periodontics or something of that nature. So there's a driver number 5, consistent occupancy of over 90% of medical office buildings in the US, even though the actual office space is under pressure. And then the other driver, and driver number 6, and I'll move away from these pretty soon, is that you have, if you notice from around about 2Q 2021, the demand or the absorption of these office buildings has exceeded supply. So the turquoise line is the demand, and the darker line is the supply. And what this really means is that there is very little supply coming into the market relative to the demand. And we all know that when demand exceeds supply for a consistent period of time and vacancies get absorbed, what that does is it means that you can start to squeeze more rental out of your medical professionals. So I think you can see from that there is effectively all of the available absorption is taking place. And certainly we are noticing that in our own portfolio where we have had vacancies, and those vacancies are all filling up this year at quite a nice consistent rate. And please jump in. I feel like I'm dominating the conversation here, but I'll start to give you a bit of a gap just now. Probably the final driver I'll talk about tonight is the cost of construction and the impact that it's going to have on our rentals as they get repriced. And you can see from this that the average cost of a medical building is roughly $500 per square foot if you take the average. Median a little bit lower than that, but you know, most of our office buildings, our A-grade office buildings, we buy in the region of between $200 and $300 a square foot, which is a considerable discount on a new building construction. Medical 42M that you'll just touch on a little bit later on this evening. If you were to build that building today, and I think I don't know what it is, 16 years old or something, but it would be exactly the same. It would be, you know, a cladding on the external walls. It would be the same design. The doctor's rooms internally would be exactly the same because they're all fitted out with new TI. So nothing really changes. Your building doesn't necessarily have to date with age, even though in the US you can change, you can claim depreciation. So I think this is a very important driver. Understand that. Quite simple. If it costs you more to build a competing office block to take up the demand for medical tenants, then the chances are you're going to have an impact on those buildings down the road that are existing. And then just finally, a few other interesting comments that we got out of, I think this came out of Revista. Triple net, and maybe you want to just remind everyone what triple net rental is, but we're trying to move all of our tenants in our portfolio to triple net over time, and Em will tell you why that is. but you can see the growth in rent growth. In other words, escalation in rentals that we build into the leases. And this started off at 2% a year or two ago, and now we're seeing leases at 3% as inflation has impacted them. So this only goes up to 4Q 2022, and I think that next year it will be quite interesting to see where that's climbed because of inflation. But maybe you want to talk a little bit about triple net, and then I'll take you into this one over here.
Perfect. Yeah. So, as Justin mentioned, in terms of trying to move to these triple net leases, really what that is that all your expenses with a building are passed on to your tenants. So there is triple net and then absolute triple net, absolute being, every single expense, which, is ideal in our world as the owner of a building, because with increasing inflation, expenses, anything that has to happen on that building, it then doesn't affect our return and from a rental income point of view, because it's added on top of the rental.
Right. And
yeah, so if we now, if we're going to move on to, do you want to speak to anything else there, Justin, or can we chat about this slide?
No, carry on.
Perfect. Yeah. So if we're looking at this slide, really what this is showing is it's showing us what has happened to the cap rates of the buildings from 2015 through to where we are now. And you'll see a steady cap rate compression from Q2 2019 to Q4 in 2022. So first of all, I guess, what is a cap rate? Cap rate represents the expected rate of return on a property based on its net operating income. So, for example, if we are purchasing a building at a 6.5% cap rate, one would expect to get a return of 6.5%. So very simplistically, if you bought a building for $10 million and its net operating income was $650,000 in year one, and you take into account the rental escalations of 2.5%, if we use your previous slide there, Justin, your building should be worth $11.250 million after your 5 years, assuming that your cap rate stays the same. So a profit, an uptick of $1.25 million, which would then obviously be available to distribute to our investors on this building. So now if we look at the 2023, you've seen, as we see, that the cap rates have now started to go up there. This is what we would expect with the rising interest rates in the US. But what this means in our world for buyers and sellers of this medical office building space is that sellers most likely won't be getting their anticipated returns and may look to hold onto their properties for longer. A positive of this is if you do own these medical office buildings, you still own a property, you've got a good income stream, which means you aren't forced to sell this building. But it has also opened up opportunities for us as a buyer in the market, if you are in a position to secure the debt. So next problem is the debt. When we go to the banks, we'll buy a building and put gearing or leverage the building roughly 60, to 65% in the US. And this debt at the moment is expensive. It has changed considerably, specifically over the last year, where we were looking at debt at around 3.75-4%, where we now 6.75%. I don't think we've gone quite to 7.5, but it is more expensive. So if you again though look at the previous slide, which Justin had put up with regards to the view that interest rates will come down, a much earlier one, that the interest rates will come down, what we are looking at with our buildings is that we will purchase the buildings, we have good relationships with the bank, we secure the debt, and then the view would be within our 5-year hold of that property to refinance our debt at a lower interest rate. And that is an agreement that, certain banks have allowed. with our Medical 42, there is an agreement there that within the period of our hold, we are in fact able to refinance that building with no breakage or early settlement fees. So something that the banks are open to and something that we are taking advantage of.
Emma, thanks. You're definitely more eloquent than me, so you can carry on. And just for the benefit of those that are new this evening, we do have quite a few new people or names that I don't recognize online. So just perhaps you can just talk a little bit about who we are. So for those who don't know.
Perfect. Yes, thank you. So who are OrbVest? Really, OrbVest was formed in mid-2018 off the back of a crowdfunding platform. It's a real estate investment company specializing in the healthcare sector. We will purchase medical buildings with existing stable income with a low vacancy rate. We will buy buildings on our own balance sheet without partners, ideally. However, in special circumstances, we will look at purchasing a building with a partner. And we'll focus on acquiring and managing these buildings to add value to the properties through the 5-year hold period of our investment, after which we would look to exit the building and share the performance and upside of the capital growth of the building with our investors. So really, our model allows investors to access investment opportunities that were traditionally only available to large institutional investors. Our core portfolio exceeds $340 million across 9 states with over 100 medical tenants that are providing a stable income that will support what we aim from a cash on cash point of view of between 6 and 8% cash on cash, which is paid quarterly on an annual basis, and an internal rate of return of over 10%. So double-digit IRR returns after the 5-year hold of the building. And, in the space we really do focus on is, the essential tenants, as what Justin also spoke around. So if you look at this slide, you can see what makes up our portfolio. Our tenants are our doctors, our specialists. We have 90% of our tenants are healthcare tenants. We stay away from office tenants unless they are credits, blue chip tenants that actually add value to our building. So you can see here, primarily it's 17% is primary care, behavioral health, dental, orthopedics, surgery. There's a great spread in terms of the tenants that underpin, or the specialities that underpin our buildings. And on this one, again, if we looked at the map earlier that Justin had said, and the fundamentals in terms of where we invest. So there is a great amount of our portfolio in Florida. We love Florida, Arizona, Georgia, Atlanta, Texas, New Jersey, slight outlier, but underpinned by some very strong fundamentals as well. And really, now if we're pulling up Albuquerque, we've got 2 really great buildings that we have a small amount of equity remaining in. This one is Medical 40, which is a building that we already own. This is a 23,500 square foot building, which is based in a suburb called, I'm jumping Albuquerque. I'm the wrong one here. Sorry, Just. Building in Albuquerque in New Mexico. And this is a just over 50,500 square foot building, which is currently got above 85% occupancy. There's a great healthy tenant mix of national and regional healthcare tenants. Our underpinning tenant here, key tenant, is Quest Diagnostics. They are anchor tenant. They've been in the space since 1999, so for 23 years. And they use this space as a centralized lab and testing facilities of all of Albuquerque and central Mexico. We've also got Sonobello and WAFD Insurance Group in this building. And really, Albuquerque was the first sort of building we'd looked at in Albuquerque, and why we really liked this was there's a great growth within Albuquerque. People and businesses were moving there for the quality of life that was centered around low cost of living, business-friendly environment, good tax incentives, and good economic trade zones, which has encouraged a great amount of business expansion in this area. And obviously with the expansion of businesses brings people, to the area as well. So we really, like this building and have a small amount of equity left in this one. The next building we've got is Medical 42.
If I can interrupt you there, just
Sure.
to remember that, apart from Albuquerque getting massive investment from some of the large tech companies in the way of
Intel,
several billion. There you go. Yeah, and of course, let's not forget the 25% of population over 65 years of age, which is a critical driver. And the fact that there's no medical vacancy in Albuquerque is just less than 2.5%. And we find that very interesting. There is basically no vacancy apart from the unlettable spaces without windows, etc. So we are actually have under contract a building which will be our Medical 43, which is about 3 miles down the road, which we've just got under contract, and we're just finalizing the DD and of course trying to find debt at a suitable price. But this is how strongly we do feel about Albuquerque, even though it is a secondary market. Sorry, carry on.
Oh, perfect. Thank you. Then Medical 42, again, a small amount of equity left in this building. This is the 23,500 square foot building based in a suburb called Duluth in Atlanta. It's actually about 10 miles from our offices in Atlanta. So our guys have been there, they know it well, know the area well, and we really love this building. It kind of ticks all of our boxes. It's well located in a high growth area, 100% let, 100% medical, close to a hospital, which we always love from a referral point of view. A lot of hospital patients are referred to these off-campus facilities. A very low maintenance building with no common areas, no lifts. I always laugh, we had this one building which was beautiful in glass and looked very pretty. All of our investors, kind of flock to it because it looks nice. But from a maintenance point of view, double stories, lifts, etc., is a far more less appealing building from a management and a maintenance point of view than the likes of, this building. And with this one, there are 7 tenants, of which 6 are in the dentistry space. So there is that wonderful synergetic relationship that Justin spoke about earlier between these tenants. A lot of them have been in this building for a very long time, and they continue to roll their 5-year leases. They've worked together for a long time, and it's very difficult for one of them to leave because they lose their market share and that strong relationship between them. We have seen this dentistry space specifically work on another building of ours as well and been very successful. So again, this really is a building that we like, and in a state that we think is very good too.
Brilliant.
Yeah, the last option is this, the OrbVest diversified holdings. And we kind of feel that this is, I say, the future of OrbVest in a way. We are moving forward. We would like, our preference is to sort of steer our investors away from single building investments towards a spread of buildings, which is really what this ODH investment offers. Knowing that property is not a straight line and that there is more risk investing in a single building, which is underpinned, for example, by 5 tenants. So there are factors out of our control that may affect a return on a building. A state may impose a tax that we weren't aware of. In one of our buildings, they've imposed that we have to have a certain lift that reacts in a certain way if there's an emergency, which is a great capital expenditure that we need to now place into that building. So if you have one investment in one building alone, you know, suddenly your returns can be affected fairly substantially. Whereas if you are investing in a spread of buildings, and there is a hiccup or a change in the income on one of the buildings, it's kind of spread and smoothed out by having exposure to a spread of these buildings. So with this ODH, we have a spread of 26 of our buildings with returns that are generated by roughly 100 tenants. So again, it just avoids that possible volatility that you would receive by going directly into a single building. You know, many investors, and if you do invest with us already, you know, and the view from an investment point of view is that they are looking at taking their million single discretionary every year and will continue to invest in our buildings. They've created their own diversified portfolio by putting money into a spread of our portfolios of our buildings. But if we're looking again at, you know, one-off single investments, this really is a wonderful, solid investment that gives you, we aim at a 7% cash on cash per annum return and still double-digit internal rate of return at the end of the whole period on this portfolio.
Fantastic. And thanks very much. Guys, I think we did not mention that there is opportunity to put your questions into the Q&A at the bottom. So please do so. Em, just to close off while people are just lining up their questions there, just for our South African investors who are concerned about the exchange rate, perhaps we should talk about this quickly, and I'll just put this little slide up here.
Yeah, is this not always the big question? Everyone wants to know, when should we be sending the rands out? You know, this, I think if we had a crystal ball, you know, if we look at this, what you've just put up here, you can see, you know, the dollar rand conversion only goes in one direction. You know, that being said, it was above 19 not so long ago. It's pulled back again slightly. And I think everyone, if you speak to any wealth manager, you know, the view is that really it's difficult to time the market. You know, you may come right sometimes, you may fall short at other times, but just to potentially continually send money off at regular intervals, and hopefully, you know, through the spread of that, you will get to a decent conversion. And again, you know, if you're depending on what your investment horizon and views are, if you've got money sitting offshore doing nothing, it may as well be working in a really great investment underpinned with strong fundamentals that we've been through. And alternatively, your rand dollar hedge, you know, just in terms of getting money into a hard currency, which is getting, you know, good returns. You hopefully will be making it up in terms of the types of returns you'll be getting, as opposed to sitting with it in South Africa. Not to be negative about South Africa. Thanks,
Em. Thanks for staying with us. We're sitting on 40 minutes, so we'll get to the Q&A as quickly as possible. You promised a dividend payment every quarter. Bernard, I won't mention second names, guys, for you, so you are happy that I don't chase you off. First of all, Bernard, I mean, this is what we are saying, that you're in an investment in a building which has a multitude of tenants, and it's not a straight line. We say that we estimate in the beginning when we acquire the building that we will give a consistent return over the course of the building, roughly at a whatever it is, 7% hurdle. So yeah, there are certainly some buildings, I think you're talking about ODH 37, that may have paid less than the projected cash on cash for a period, but we're not judging it on that particular quarter. We're judging it over the period of the investment. And so if it's fundamentally a good building, then it should continue to pay a consistent dividend, which should work out. And with the capital growth that Emma explained, yeah, it should average out to be, roughly where we said it should be. So I think, that's really it. There's no guarantee that you'll get, your full estimated quarterly return on any particular quarter. As Emma mentioned, I mean, she talked specifically about a building that we have in Florida. The insurance on that same building that we have just been told by the state that we have to install a $25,000 gizwig to the lift for some purpose that we don't really understand. The insurance went up from when we acquired the building at something like $56,000 to $290,000 in the course of a year. So these are the headwinds that you occasionally have to deal with. Will we get that down? Yes. Our intention is to get it down with more of a portfolio insurance approach rather than a single building approach. But the fact is that for the meantime, it's going to make an impact on distributions. So I hope that answers your question. With the surplus and empty office space, Thomas, thanks. What stops landlords from slapping a medical center sign on the door and converting them to medical buildings, causing an oversupply? No, that's a very good question, Thomas. And I think that, first of all, medical officers have to have certain criteria. So first of all, there's a minimum amount of parking bays. You can't just slap a sign on it. You have to get permission. You have to get authority, and you have to prove that you've got sufficient parking to have to be able to get the license to put medical tenants in. And that parking ratio is higher than office, and most offices are built maximizing the amount of parking that they have available for their offices. So that's the first thing. The second thing is some states it requires a porte cochere, which is like a portico, so that if an ambulance arrives, it can park out of the weather. There are requirements for special treatment of water waste. There's requirements for backup power. And in certain buildings, certainly if we've got heavy medical, then there is a requirement for gas, or oxygen, basically, which is plumbed into the building. So, there's a number of other factors which I might also have left out. There's a thing called a certificate of need, where the building has to prove that it has the need for that particular medical service. Otherwise, so basically, if your tenant leaves, the tenant can't take the license to practice with them. It remains with the building, and that's really to spread out the supply of services in areas where, in those particular states, they feel that they are necessary. So lots of little things, and also, as I mentioned earlier on, the synergistic relationship between the doctors. It's really handy if you, for example, have a laboratory and you are a general practitioner, as we call it in South Africa. Then you would obviously, be able to send all your bloods and your patient to have the blood actually drawn from them to the laboratory. So that saves you some significant effort, and of course is more beneficial to the patient. As with our dental buildings that Emma mentioned earlier on, you go into your general dentist who sees that your child needs to have some orthodontics, and they send you across the passage to the orthodontist. So there are these synergies that are super important. Finally, I just want to mention that if you look at the occupancy, not tailing off at all, even though there is a huge surplus of office space at the moment on the market. What do tenants think about triple net, Nick? Yeah, no, that is a good question. I think that they would prefer not to have triple net, but remember that the gross lease is at a higher number. So, you have to discount the gross lease to give them a triple net in order to, and obviously, Emma, you explained it quite well, but all of the expenses of operating the building, and that can go right through it to an absolute triple net, where basically you do nothing but collect the check. They're responsible for the maintenance of the building, the roof, the HVAC, absolutely everything. So you just pass all those expenses over to them. So definitely in our interest, and you know what, tenants are buying it. I think that we've got about between 60 and 70%. I'm not going to put the exact number because I can't remember exactly what it is, that we've now got up to triple net, which is a great, a hell of important for us, Thomas, because with inflation as it is at the moment, you can push those costs over to the doctor.
Yeah, and another way to entice tenants, if we've got leases that are sort of coming to an end, and to convert them to these triple net, is we often allow some tenant installation or some, renovation or revamp within a medical space, that we will, provide that for the tenant, and obviously factor that into the rental. So we do recover it, but it's obviously not a capital outlay that those tenants need to perform upfront. And that's, it just buys the loyalty and kind of ties them into these leases.
Why don't you do this one on, do you have to invest for a 5-year period in diversified holdings, or do you have a shorter investment period in other investments?
So again, generally, it is a 5-year period. Each one of these buildings, including the ODH, is listed on Merge, the Seychelles Stock Exchange. So if you needed to sell your shares in these buildings, you would be able to, willing buyer, willing seller, and be able to, potentially sell them. Internally, I must say, I don't know if we have been in a position where we haven't been able to facilitate somebody needing to exit a building for whatever personal reason. If I've invested in medical 29 and I want to exit it early, an investor, I've got a list of them that would like to purchase one of those shares when you're 3 years into an investment, dollar for dollar, because you're getting your capital kicker, in a shorter period. So generally, we have always been able to facilitate, smaller sales of shares within our existing investors.
Thanks, Em. Roelof, great question. And I think I'm going to try and stay a little bit away from giving you a direct answer. All I can do is give you an opinion. And I think that de-dollarization will happen over a long period of time. But I think that, the fundamentals are such that there is so much reliance on global trade on the US dollar. It's not going to be a disruption. It's going to be a slow ebbing away over the period of a few decades. Just to consider a few points. Remember, the euro came and everyone talked about de-dollarization. Everyone would move into the euro. Didn't happen. And I think that we've also got to understand that, the US still produces 20% of the world's oil. And that's a figure that is almost unbelievable. If you consider that Saudi Arabia, I think, is about I'm going to give it a guess, 7.4%, and they come second. So, there's still an enormous amount of global trade, even if we exclude the petrodollar, that is made in dollar. And I think it's going to take an enormous amount of effort for someone to come up with a trusted alternative to that. And I think that's the big word, is a trusted alternative. But Roelof, don't take my advice. I certainly don't have any expert opinion on it. I'm just giving you my view. Chaman, nice to see you again. What's the progress with 26 and future prospects? I think that that is a more complicated question. Chaman, 26 is we'll be able to do some sort of a release in the next couple of days or so. I'm expecting to get some input from Andrew, who was at the building yesterday, so we'll know a little bit more about that. Anonymous, how many investors does OrbVest have in the US and non-US? Okay. Interestingly, we don't have a lot of US investors as such, because we have traditionally focused on raising money in South Africa, but we have a lot of international investors that invest through the US with LLCs. So difficult to give you an indication of what that looks like, but a lot of international investors, specifically out of Israel, I would say they're probably the largest amount of LLC investors that invest directly through the US. So I hope that answers that question. And John, can you please expand on the definition of all expenses in a triple net? Obviously you didn't do a great job here, so you want to have another bash at it?
You give it a bash. I clearly missed it.
What is triple net? Effectively, John, it is basically apart from your normal rental that you would pay, you are required to pay your pro rata share of all of the expenses incurred at the building, and sometimes there are some that are excluded. For example, a roof repair or something like that if you're in a building that you share with other tenants. But absolute triple net, as I mentioned earlier, means that you effectively, your tenant is responsible for the entire operating cost of the building. Now, maybe to expand on the question we had a little bit earlier, you don't want to be loading your tenant with too many expenses, so you still have to manage the expenses. Why? Because at the end of the day, the tenant is paying your rent, and if it works out to be $40 a square foot, it's $40 a square foot. And if he could move down the road to a new building, which is $42 a square foot, he might leave you and go there. So, he's going to look at the end of the day at the gross amount of money that he pays you. But for us, we don't want to take the risk of any increases that we can't pass on to the doctor. In a high inflationary environment, bear in mind the doctor has the ability to push up his fees in order to charge a fair price, fit for market. Whereas if we locked into a 10-year lease agreement, we can't do that. So we want to push those operating costs over onto the tenant. Another anonymous, how much uptake was there to use the notes option to park funds since launch? Okay. So we were getting a lot of questions from tenants that are sitting with money, and just for those of you in the US, just understand that for international investors, they can invest via the merge exchange, which means that the funds sit in effectively the exchange account and earn no interest. So in order to solve for that problem, we created a note that you could effectively move your funds into the note and earn 5% interest while you were waiting to A, accumulate money to put into another building, or B, keep your money there because you don't want to repatriate it back to your country of origin. So has it been successful? No, I think it hasn't. In fact, we just increased the fee from 4% to 5%. Is that right, Em? Yeah. So yeah, so it hasn't had a huge amount of traction, but then really it was just designed to give people that are sitting with money in their wallet or in their trading account, so that they can earn something on it. So
yeah, but in reality, I think the reason, again, if we look at why it wasn't necessarily taken up, it's because the ODH has, once we consolidated with the 26 buildings, people will then reinvesting their dividends directly back into the ODH investment, where they are now, earning a 7% return. Yes, it is for a 5-year period as opposed to a 60-day on the notes, but majority of that money that was then kind of earmarked or getting placed into that note, I feel has actually been reinvested into one of our buildings or into that ODH.
Thanks, Em. Final question that's on the screen here. Simpiwe, sorry. Would you expand to other states? This has been quite a big debate. I think that our investment committee has approved 1 or 2 other states, Colorado, I think, what am I missing? South Carolina, we haven't got a building there. And what am I missing? But beyond that, Simpiwe, we want to focus on those states that are, as we mentioned, fast growing, aging, and of course landlord friendly. I must say that's another thing that's important. Taxes are also an issue. It's no good earning a good return out of your building but losing some of it to taxes.
Yeah,
so
another very important thing also we always look at would be what other industries are in a state and an area. It mustn't just be a medical node. What else is driving the growth, the GDP growth, people coming in there? So exactly like in Albuquerque, you've got the tech teams, you've got the solar, So we look and we like there to be more than 5 other industries outside of the medical space that are driving a state and an area of a building that we're investing in. One of the criteria, there are many, but that is another thing we look at.
Thanks, Emma. Howard, good question. Lease escalations. I think some of our older leases are still sitting at 2% as they roll over, so we push them up. I think our preference is 3% escalation on leases. I hope that answers that question. Excellent. Ladies and gents, thanks so much for joining us tonight. Emma, thanks for supporting me here. And I see there's absolutely no other questions. Em, how would anyone get hold of you if they wanted to talk to you about any of the investments or talk to one of our consultants?
Yeah, so I think existing investors, obviously you can contact your consultant, your OrbVest consultant. Alternatively, on the website, www.orbvest.com. And you can, contact us via there. Myself personally, emma@orbvest.com. You can also always email me, and, we can set up time to chat.
Guys, thanks very much, and appreciate you giving us your time this afternoon, this morning, or this evening. Cheers.